Welcome back, everybody, to today's Market Explained, the FourStar Media event. This is Brian Castle, and I'm your host. And along with me here is Chris Reardon, my co-host, longtime co-host, Chris Reardon. Welcome, sir.
Thank you, Brian. Glad to be here and glad to talk a little bit about the markets on this Wednesday.
Excellent. So we have our standard program today where we're going to talk about the financial markets. We're going to talk about what we see out there. We're going to talk about the economy and learn a little bit what's happening. It's a very, very confusing time. And the markets themselves, are all over the place right now. Chris, let's try to make sense of this. What do we see in the markets in the relationship between the stock and bond market and different asset classes that are out there in this particular period, Chris?
Yeah, I mean, kind of interesting. I think some people, obviously, we've seen a little bit of volatility the last couple of weeks, at least spikes of volatility. So they might expect maybe a drop in domestic equities or something, but it's not really what we've seen so far. Domestic equities is still holding that number one position, and it's as 321 tally points and is unchanged from the last podcast. So it's still kind of holding firm in that number one position. And the kind of 2 and 3 position, we have a tie, and we have seen a little bit of change there with international equities at 240 and -9 from the last podcast, and commodities at 240 and -9 as well. So we have both those asset classes really moving simultaneously, kind of in the same direction. And they've been kind of in lockstep, really. They've deviated here and there, but for the most part, have been in lockstep the last 3 weeks now, maybe going on a month. In that number 2 position. So they've been kind of jostling back and forth. And then in the bottom 3, which are more defensive asset classes, all those gained. So cash is at 125 now. Tally points, it gained 5 points from the last podcast. Currencies is at 90 tally points and it gained 9 points. And fixed income, that's at 74 and it gained 5 points from the last podcast. So, we continue to see these risk-off asset classes gain, and international equities and commodities continue to pull back. I think they topped out at around 270, so they're a little bit off that high. But domestic equities, I think, is the outlier. It, for the most part, has held up in that number one position. So, I mean, I think the volatility spurts we've seen, like I said, some people might anticipate those causing a little bit more. And certainly that might be what's driving as far as cash and currencies and fixed income, these safer asset classes moving up slightly. But so far, we really haven't seen a 20, 30, 40 point move within a week or a couple days. We haven't seen that movement yet. Not to say it's not coming or it's never going to happen, but so far, things have been relatively stable from an asset class perspective.
So we haven't seen that much movement in all the other asset class sectors. But we've seen a little bit of gaining on ground on the risky or the scaredy cat sectors, cash and currencies. Currencies have made a big move, almost a 17 tally score move, but not much other movement going on. A little bit up in fixed income, a little bit up in cash. But it's really been still primarily domestic equity, even though equities have gone down. So we come into a week ago Thursday and had a huge collapse on Thursday, huge collapse on Friday. And then predictably, Chris, Monday opens up. What happens the first hour of every Monday after a bad Friday? The public sells. Mm-hmm. So it always makes me wonder why, when folks make the same decision over and over and over, they hear things over the weekend, they don't think about it for a second and say, maybe I'm not going to just knee-jerk react. But sure enough, the public seems to make that mistake over and over and over. Maybe that's the human condition, Chris. I don't know. But the first hour of the day was seen by retail selling by investors all over the country. So we had a huge, huge down day Monday, but it ended up traveling upward. And then by the end of the week, the market was basically flat. So it was really the 2 net days of down the previous Thursday and Friday. And so, but there was a lot of movement, a lot of drama in the public panic. But now we're kind of in this slow, upward moving market, kind of downward moving a little bit, kind of like trading in a range is all we're doing. But, at the end of the day, not much happened, and domestic equities went up during that period of time. Isn't that strange? Relatively to other asset classes.
Yeah, I mean, I think it's, you're really interesting. And I think one thing, important thing that's to point out is, we had that, it's kind of started Thursday the week prior. We had that volatility spike, that big drawdown, and going into that Friday. And like you said, Brian, when the investors have a chance to really digest, I mean, sometimes when you have a big movement intraday, especially during the week, investors don't know, right? And so they don't even have that chance to panic sell. But when they have that weekend to digest things, they can kind of be ready to go first thing Monday. And that tends to be what happens. You see all these people kind of, sell out of that fear, out of that panic.
Yeah.
And then what happened kind of coming that Tuesday to Wednesday, some of this, we've talked a little bit about this before, was based off of that Japanese kind of reverse carry trade, in which you had a lot of hedge funds, a lot of managers, professional managers, traders that were borrowing in the weak yen, which has a low interest rate, on utilizing that to invest in, whether it's, from the conservative perspective, you could invest in, US fixed income, or a lot of people were using it to invest in, let's say, NVIDIA, or invest in these high octane US stocks. And then they were also, consequently, they were also shorting maybe small caps or real estate. So you saw that kind of come off a little bit. And that mostly happened because the Bank of Japan came out, I want to say it was Tuesday in the United States, at least time zone, came out and said that they were they were going to take into consideration global volatility and they wouldn't be hiking anymore. So it took that option of surprises, which if we discussed a little bit before, this all kind of came to the forefront with a 15 basis point hike from the Bank of Japan that kind of surprised people.
Mhm.
So that kind of calmed people's nerves a little bit. I think, calmed down that flight to the doors, stabilized things a little bit, and kind of
Mhm.
slowed things down a little bit. So ever since then, things have kind of stabled out a little bit. As you said, last week, we kind of saw things kind of move back upwards. And for the most part, this week, we've kind of remained in that same trajectory, although it's really been a drip by drip kind of market right now, just based off of
Mhm.
economic data.
Yes. Yeah. So it's been quite interesting. Now we're going to see what happens because the economy is slowing, but some of the numbers are slowing down. So we're going to talk a little bit about what's going to happen with interest rates and what the risks are here. But Chris, why did all this happen? We've heard discussions about the carry trade, right? Let's talk
Mhm.
about that.
So, I mean, the carry trade, since you're borrowing in the Japanese yen, you're utilizing that to, and usually it doesn't have to be the Japanese yen. The reason this has kind of come to the forefront now is because a carry trade is a general term, and usually you're borrowing in a currency that is depreciating, and investing in a currency that's appreciating. So it makes sense. That way, if you buy you're borrowing, if you buy and sell NVIDIA, if that asset depreciates more, you have to pay back less, or if that currency depreciates more, you have to pay back less. So you can see the benefits of this. Now, what happens if you get a large movement in the opposite direction? Well, things can get tight very quickly. And that's where you can see what we saw, the spike of volatility. Um, the tough part of this is that Japan wants to raise interest rates because the Japanese yen has been notoriously weak. Japan is on an island, so they are an import-driven economy. And so what they have to pay for in gas and oil and a lot of products, they have to pay for in essentially dollars. So when their currency is that weak, a lot of the Japanese consumers and people that live in there essentially are paying these very high prices for goods. So that's why this comes about. The tough part that the Fed has is when they lower rates, this actually only makes things worse. Because as I said, you want to go short a currency that's weakening and long a currency that's appreciating. Well, now the dollar will depreciate if we lower our rates. And now if you have the Bank of Japan, raising interest rates, you have the yen appreciating. So you almost have a flip there. Still, they're very far apart. Obviously, they're at like, essentially zero. I think 25 bips, call it, for their interest rate. Obviously, we're, five and a quarter or so. So the big difference there, but there's still, I think, a lot that could be said here as far as volatility spikes we could see over the coming months as this kind of continues to unravel.
Exactly. So it's a strange time. Of course, the market had recession fears as well. So that all that kind of built up into this little thing. And one of the discussions that was going on Thursday and Friday of that week was about a crash. So all of a sudden, all these commentators are saying, "Oh, it's a crash! It's a crash!" And if enough people say things like that, then people start to believe those things, and that of course happens in the political world all the time. But then sometimes like narratives develop in the financial markets too. And so there was a big discussion on Barron's Roundtable over that first weekend, all about what is a crash? What is a crash? A crash is when the market's down like 10% in a day or 20%. I remember fall of 1987 when the S&P was down 21% in one day. That would be a crash. That would qualify as a crash. Or when a market goes down and 10% it's a correction and 20% it's a bear market. But a swift move down to bear market territory is often called a crash. But a 5% move or a 6% move in a couple of days, then a bad opening and a rally in the close, that's not a crash. And so we need to get that kind of discussion out of our lexicon, out of our narratives, because people are like heavy breathing and panicking, and then getting people to make decisions. And I think maybe that talk of crash over the weekend on all those TV shows might have led to that really, really rough opening on Monday, because everybody got excited watching these shows, and all of a sudden everybody's got sell tickets right on the open, right?
Mhm.
So we can help contribute to our own volatility by our bad behavior and our narratives and how we see things and think of things. And we kind of have a rule of thumb in running the FourStar investment portfolios that whenever we have a big day like that and a huge move up or a huge move down, if we were going to make moves that day, we will often just stop and wait for that day to end, see what the next day or two brings, and then decide whether we're going to resume those moves or not. But making bad decisions on days like that is usually never a good one. So if anybody sold that Monday morning at 9:30 in the morning Central, and after the market opened at 8:30 in the morning Central, they actually sold at the wrong time based on today, isn't it, Chris? So they probably lost themselves 5% on average on whatever that they bought. They
Yep.
sold it and then went back up 5%.
Yeah, and depending on if it was a single stock, I mean, you could even have more. I mean, I know Nvidia has rebounded up almost like 10% off of some of the downs that it saw that initial Monday. So, yeah, I mean, I think that the one thing that's important, we've talked about this a little bit, is, I mean, the news, what you see on TV, I mean, that's there to get eyeballs, right? To get views. They're there to cause a stir. They want, and crash. It sounds scary. It's going to get people to, watch it. People are going to listen. People are going to watch the shows. They're going to, well, feel like they're kind of their pulse quickening, things like that. So it gets people excited, probably in a bad way, but excited to a degree. And I think, it's important to note that, what you see on the news isn't always, there is a show to that, right? There is a
Mhm. They're
you know
selling ads. Yeah, they're selling ads, Chris. That's what they're doing. And the
exactly.
more controversy they create, the more ads they sell. But that doesn't help the markets and doesn't help your portfolio.
No, it's exactly right. And I do think it's important to point out that, a lot of the stuff we're saying, I mean, there is things under the hood, but a lot of this is driven by, the banks, world banks, things like that, governments. And, for the most part, those entities don't want to see chaos or markets collapse, things like that. They want to see it just as little as we do. So, does that mean there's a bottom or a floor? No, not at all. But that does mean that they're going to do everything they can to try to at least calm things. So, and I think taking a deep breath, especially during these times when things are really driven by the global markets and global banks, things like that, it's important.
Exactly. Well, good. Well, interesting times. We'll have more panic moments like this again. But now we'll see what the economy is going to do, and the markets will generally follow what the economy is going to do. Things are slowing down. Let's hear a little bit about the economy, Chris. But before we do, if I can, I just want to make one more comment about some big news in the markets that happened last week. So Google was finally designated as a monopoly by a federal judge. And so, many positive things have happened from the technology boom in the last 30 years, all the way from the tech growth before the tech crash in 0102, then all the softwares and all the development that came out of it. So technology, primarily driven by companies in America, has brought tremendous prosperity and tremendous efficiency to the business world. In fact, we're going to talk a little bit about population growth and why population growth is changing fortunes for investors. But a big part of the growth of the world is that technology. So it's exciting stuff. At the same time, some of the technology companies have become so monopolistic that they're now using some of their monopoly power to control their markets and control investors, also using it to censor people. So there's a lot of things that happen when a monopoly is in charge. And so Google finally got designated as a monopoly. We're going to see some changes in that industry, in the search industry, and all the other industries that Google gets involved in. And so I think designating them as a monopoly is a positive thing because that'll hopefully bring some change from the abuses of monopoly power. And Microsoft is doing that for a while. Google has been doing it. A lot of big companies back, people might remember from history when the oil companies were dominated by a certain couple of companies until there were things that were broken up, or the railroad companies in the late 1800s. So whenever we have monopoly power leads to also abuse of the public and other things. So that's what people have seen. And so now Google's a monopoly, and we'll see how the industry changes. But Chris, let's talk about that economy. Where are we going to go? Where the market's going to go? It all really focuses on the economy.
Yep. Yeah, and I think we got two big metrics that came out this week. The first one that came out was actually the PPI, or the Producers Price Index, and that increased 0.1% in July, and that's month to month, and that was up 2.2% year over year. And that came in better than expectations. And the Producer Price Index is important because this is obviously what the producer is paying for their goods. So usually, if you have a rising input cost, usually it's a rising output cost, or a higher, cost to the consumer. So that's good to see that slowing. That shows that potentially, we shouldn't see any lags, if you will. If we saw a really high PPI and even a low CPI, which is the consumer kind of version of that, there would still be probably pause, because you could see a lag effect to the CPI. But the fact that that was lower, that was very good. And then just today, we got the CPI, or Consumer Price Index. That was up 0.2% in July and 2.9% year over year, which is the smallest gain since 2021. Core CPI was up 0.2% and 3.2% year over year. And core strips out energy, food, which tend to be a little bit more volatile. But interestingly, kind of the components of that broad CPI number, the 2.9, year over year, housing was still up 4.4%. So we still have a housing issue that's going on. Goods and services were up 4.2%. So I think primarily services, especially are driving some inflation there. Medical costs were up 3.2%. So that was at the high end of that number. And at the bottom end, apparel was only up 0.2%. So that was relatively flat. Education and communication was up 0.9%, and transportation was only up 1%. So we are seeing some positive signs. I think interesting thing with apparel, especially, is that, points to me to consumer consumption, right? And, could that be also a sign of lowering consumer demand? Which, as Brian had said, could that mean we are headed towards a recession, less spending? So it'll be interesting to see. But all those numbers were taken as kind of a green light in many ways, that the Fed will lower rates in September, or at least kind of the last hurdle that had to be addressed there, at least so far. So, right now that's being baked into the markets. On the flip of that, we got initial unemployment claims for the first week of August, and they came in at 233,000. For that first week. Forecasts were for 240,000. So that was actually overall positive for the labor market. And that was good. I mean, this came after the non-farm payrolls the week prior, kind of the last week of July that came out. They painted a really grim picture of the labor market. So we're really getting contrasting data here. And with that, we're seeing some of these swings within the markets, up 2 or 3%, down 2 or 3%, as the market digests that. And so what's going on right now is what's being baked in, if you will, is a September rate cut is really being baked into the markets. I think the unknown variable that's out there right now is that rate cut too late? And are we really headed towards a bad recession or a recession? So that's really, I think, what's driving the markets right now from one, and that's that drip we're getting of economic data that you alluded to, Brian. Um,
Mm-hmm.
and so with these numbers, the last thing I'll highlight from an economic perspective is the average rate on a standard 30-year fixed mortgage fell to 6.47%. That was this past week. So that's the lowest it's been since 2023. So, we'll probably see the next time we do this podcast, most likely it'll be even lower. We're going to start to see those kind of dip down as these rate cuts start to get kind of baked in affect the lending rates.
Yes. Well, it's interesting. Now, you mentioned about how folks are concerned that maybe we didn't lower rates quick enough. There's a whole nother school of thought to that, Chris, that, now with inflation staying stubbornly at 3% and not really breaking, and the Fed had said they would only move once they got inflation down to 2%. Well, we're not at 2%, really. And when the new administration started, inflation was in the mid ones, like 1.4%. So inflation has been elevated all through this recent administration. And so they said they would raise rates and they wouldn't lower them until we got below 2%. We're not below 2%. But a number of these CPI numbers are coming in slower, which is good, but it still hasn't brought the final numbers down below 2%. But yet, some people are very concerned because certain numbers are going down so quickly, like the employment numbers. So they're seemingly getting talked into lowering rates in September. So everyone, the probability now among traders is over 90% belief that they're going to lower rates. But if anybody who was around in the 1970s remembers, by lowering rates in the late 1970s after inflation wasn't quite solved, they actually ignited inflation again. And they had hyperinflation into 1980 and 1981. I was a college student at the time, and I don't remember it from that perspective, but I do remember the fact that we really saw that spending explode. And so the Fed is really at risk of that doing that again. So is the Fed moving too quickly rather than too slow? Are they moving too quickly? Should they actually let the market recess and go down first and get inflation out of the system before they lower rates? I'm of that opinion. I think that they should probably wait, but I could be wrong. I'm not perfect either. I don't know everything, but if they do lower rates before they reach their inflation target, they could take that risk, and so that's a risk I think the Fed may take now. Chris, we'll see.
Mm-hmm. Yeah, I mean, I think there's several, and that's a good point, that's really not even being looked at by the markets, but you do definitely have some, especially geopolitical risks that could cause spikes in oil. You have still Iran and Israel that are going back. Right now we're kind of in a standstill right now, waiting for a potential retaliation from Iran. So you have a lot of tension going on in the Middle East. You have Russia and Ukraine, you have potential with China and Taiwan. So there's a lot of things out there that could, send a jolt of inflation through the system. And then on top of it, what you said, Brian, I mean, inflation really is a supply and demand issue, right? And what we've really seen these past couple of years is demand has just been out of control. You've seen just people having all this money to spend, and usually when you have a recession, you have job loss. I mean, these things aren't good things. But what that does is that depresses that demand, and that's going to drive down prices. If there's less demand, supply stays the same, then they're going to lower those prices to hopefully, attract more demand. So, without that recession, are we just kind of putting a Band-Aid over it in the short term?
Right. Right. And is the Fed ripping the Band-Aid off too quick? That's the thing that I'm concerned about, right? So,
Yeah.
so let's hope that the Fed makes the right move. In the defense of the Fed, they're often dealing with information that is limited. They don't have complete information at any given time, and there is a lag time to all these different effects. So, the interest rate increases, maybe the interest rate increases that we've kept 5% Fed funds rate will the effects of that for the last 3 or 4 months will affect the economy over the next 3 or 4 months. That even rate decreases now won't excite the economy strong enough. Maybe my theory is wrong. All I do know is back in the late 70s, that's what they did, and that was a mistake that the Fed realizes they made then. They eased too quickly because we do have right now still about 1.5 to 2 trillion of additional above revenue spending. In other words, deficit spending by our federal government. And that deficit spending has been inflationary. And that's kept inflation high. That's kept spending high and inflation high. So we already have that wind under the wings of the economy. And what if we hadn't had that? Would the economy have recessed quicker? Well, that's not going away because our politicians aren't changing that spending. They will change that spending when they finally blow the debt system up. We're up to 35 trillion now. It's getting really out of control. There will be an end game to that, but right now we don't see it right in the short run. So they're going to keep doing what they're doing. And
Mhm.
so with that backdrop of overspending by the government, they're going to put more money on the fire. We'll see if that works or if that's a mistake. I'm worried that it is, but we'll see. I hope I'm wrong. All right.
Yep.
Chris, what about international?
Yeah, so interesting. We got some mostly out of the Asia Pacific. Chinese exports came out and they rose 7%, which seems very large year over year in July. That was actually down 8.6% in June. So, and that was below the expectation of 9.4%. So,
Wow.
even though we continue to see high numbers out of China, it is under expectations there. And we continue to see most of the data there is kind of lagging. In some areas, we've seen it steady a little bit, but for the most part, we still see kind of that contraction, if you will, there. And then in Japan, which is obviously a hot topic right now, their prime minister came in and said he's going to resign in September. So they will be getting a new leader. So that's really interesting. You know, one of the big issues that this prime minister has really run into is the currency issue. So the Japanese yen has been so weak over there that a lot of his constituents are just kind of fed up. You know, if you know we complain about inflation and costs of goods and eggs and that stuff. Well, you know, they're on an island. They're an import-driven market. They're an import-driven economy. You can imagine with their currency at, you know, decades lows, the prices they were having to pay in Japanese yen, it wasn't positive. So he kind of saw the writing on the wall, the pressure, and he chose to resign. So we'll see who takes the place there in Japan and if they're willing to make changes. You know, once again, it's really interesting because, you know, they're kind of between a rock and a hard place. You know, to really raise and defend that currency, they have to raise interest rates, which in turn really creates global volatility. So we don't know what's going to happen, but we'll just kind of have to wait and see.
Exactly.
Going on to a couple things I'll note real quick with commodities. I thought this was really interesting. We got a break. There was actually a breakthrough this past week in oil production. So now oil producers can safely tap ultra high pressure oil fields. You know, these are oil fields that mostly right around us are in the Gulf of Mexico. But this has an estimate of putting up to 5 billion barrels of previously inaccessible crude oil into the production. So we're going to see potentially a big increase in supply. You know, that's overall very good. I mean, that hopefully affects us at the pump. It's obviously domestic oil. Most of these wells, like I said, are in the Gulf of Mexico and they're being operated by Chevron and BP. And Chevron just this past week actually disclosed that it pumped its first oil from an oil field that was at 20,000 pounds per square inch or PSI. That was actually a third greater than any previous. So it was the most pressure that they've been able to kind of keep without having a blowout, similar to the Deepwater Horizon. A lot of you will remember things like that. So overall, that's promising. Obviously, technological advances there that have really helped. And hopefully these advances will help, you know, bring a little bit more oil on the market, ease some of these pressures. And, you know, obviously there's tensions in the Middle East. There's tensions, obviously, in the Eastern Europe, things like that. So the more we can depend on local oil, the better it'll be, and less shocks. Hopefully, we'll see from the oil markets at least.
And there's such a cohort of people, Chris, that are against oil production. It's really more of a political thing, and has to do with global warming and pollution and things like that. And obviously, many efficiencies have come into play, and so things are much cleaner than they used to be, at least in America, not in China and other countries. Um, you know, but once again, they keep coming through with new technologies to make it much more efficient. Fracking managed to find oil in locations that we couldn't normally get it by by infusing water into it. Now, new technology to get more oil yield in previously unavailable oil fields that they knew were there, but they couldn't get at. Now
Mhm.
they can get at them. So it's still exciting. There's still plenty of oil in the world. So we'll see how that all shakes out. Some of it's politics and some of it's reality. But we're, at least there's more technology every year. There's always people doing work on this technology. So it's exciting.
Yeah, yeah. I mean, I think that's a great point. I mean, it's a lot easier for us to make our existing energy more eco-friendly, if you will, than to try to push solar, wind, and solutions that really just don't have the technological advances to be there yet. Not to say they won't be down the line, and I'm sure once they are, or fusion, or whatever the solution is, I'm sure people will happily move there. But numbers don't lie. We're just not really there yet.
Exactly.
So,
Well,
um,
great. Well, thanks, Chris. Well, go ahead.
And then the last two quick notes that I'll just mention is we're seeing gold finally move up again the last couple of weeks. Most of this
Right.
is based off of volatility we've seen out of the Middle East, as I've said, and the potential rate cut that's pretty much baked in now. You also have some people that are baking in a 50 basis point rate cut in September. That's obviously a little bit more of a trader's bet really going on, but we're seeing gold kind of strengthen again. We're seeing copper prices kind of steady and rise again as well. Most of this has been out of potential improved consumption out of China and anticipation of these rate cuts improving the economy.
Okay, great. Well, and there's been lots of debate we've talked about on the show about gold versus Bitcoin, and why is gold moving? Gold has some real value. Bitcoin doesn't really have real value. It's just a pure commodity. Where gold has uses for dental and industrial and other things, right? And certainly a storehouse of value as a precious metal. But gold was dormant for a long time, but gold's been moving the last year again. So gold is now the new gold. We used to say that Bitcoin was the new gold, but now gold is again the new gold. So that's interesting trend, and Bitcoin's up there too. So people are looking for other things than currencies because we seem to be blowing up all of our currencies. There's never been a currency in the world history that's gone more than 200 years besides the American dollar. And by the way, we're running deficits and debt. We're doing a pretty good job of preparing to collapse our own currency. So hopefully we can come back from the brink and not collapse our currency. But people are getting a little scared with all the debt, and so they're buying gold and they're buying Bitcoin, they're buying other things, and so the moves in gold maybe are not a positive thing for society. Let's hope America can figure out our dollar and not let this thing collapse. So. Um, so, Chris, and what we see out there, it was an interesting report I wanted to mention everybody. Piper Sandler, one of the research houses out there, did a piece on global growth, and global growth is a function of population growth. And the working age cohort that creates all the growth in the world, age 17 to 64, peaked in the year of 1979. So that's actually contributing overall to a global growth slowdown worldwide. That said, the population is still growing, but not at the pace that it was. Okay. So now in a binary world, this would lead to slowdown in growth, but yet we've seen growth in the world economy, in the markets and everything else. So what has caused all that growth since 1979? Well, it's efficiencies and technology and other new breakouts in technology that have caused that. And that'll continue to happen. But there is a natural tendency to slow growth in the world because of population growth. And so that's a natural tendency because of prosperity around the world. So a natural consequence of prosperity is families would have less children. In less prosperous nations, they have more children. And so that's a big aspect to this. But I thought that was interesting. So the base level report on growth is that growth is slowing.
Mhm.
Population growth is slowing. So technology is what's going to take it up there. So we need to be the leader in that. America is the leader in innovation, and let's hope that continues. And we have higher productivity and worldwide growth to make up for the fact that there's little population growth in the world.
Yep. Yeah, I mean, I think that's a great thing to point out. I mean, I think we've talked about it. I want to say a year ago, it was a little bit more in the news, but China is having huge population growth issues, and it's actually contracting. A lot of this is due to policies and everything, decades ago. But it definitely kind of seems to be a trend that's here to stay, at least so far.
Exactly. So, Chris, there's some other interesting stories out there you have as we kind of wrap up here today.
Yeah, a couple just things to note. Disney came out, reported their earnings this past week. For the first time, they reported profit from their streaming service, Disney Plus. So that was overall really good for the company, which has been struggling as of late. But they hinted that their theme park numbers would kind of put a dent in their overall profit. So even though now they've seen their streaming service, strengthen, their theme parks are really starting to hold them back and draw revenues away. So it'll be interesting to see how that plays out. I know they just came in, I think, are doing a big revamp of their theme parks. So we'll see if that, has any impact. Obviously, they're in Florida and even California. They're kind of a big employer. They're big companies there. And then Starbucks came in. They tapped Chipotle head Brian Nickel as their new CEO. Kind of out of a surprise move, really, out of left field. But really interesting change there, overall. And then one thing to note with it is the last 3 years, I think Starbucks has been down, I want to say 30% the last 3 years, their market value, whereas Chipotle has seen a 20% rise. So overall, the market's really taken this, I think, as a positive for Starbucks, and that Chipotle has really lost a valuable asset there.
Yes.
And then today, M&M Mars, the candy bar maker, came out and said they're going to buy Pringles maker Kellanova for $36 billion, which is going to be the biggest deal so far in 2024. So we're starting to see a little bit of that's positive overall for the economy. We're starting to see some deals get done. We do see a slowdown with high interest rates and some of these deals because obviously, with more money, higher interest on debt, things like that. So that's positive to see. And then the last thing I'll mention is Ukraine had a big push into Russia, their Kursk region, which is kind of the northern part from where the battles have been, and they gained hundreds of miles of territory, and it's kind of created this bubble. And so this is the biggest foreign incursion into Russia since World War II. And just, I believe it was either today or yesterday, Russia said they're having to pull troops now from their front lines to help push back this unexpected offensive. So, really the last couple months, it's been almost a stalemate, kind of a slow grinding war with mostly Russia gaining ground in Ukraine. So really interesting maneuver here. And we'll see, does this change the momentum a little bit within there? And, the impact it could happen that could have on the global economy, obviously, it causes maybe more provocation from Russia now. We'll have to kind of see, but, it could have global impact as well.
Yes. And Chris, those are really all interesting points. This comment you made about Starbucks before, I don't think I've ever seen an example of a more graphic example of what your self-worth is. So the CEO of Chipotle leaves and that stock goes down 10%. But then he joins Starbucks, which is a sister company of Chipotle's, and he goes up 20%. So one stock's down 10, one stock's up 20. And so I guess the differential, 10% in Starbucks gain, that's his personal worth. And that's a good way to know what you're worth, isn't it?
Yeah, I mean, I guess it's a resume builder, I guess you could say.
all in one day. What's the value of 10% of Starbucks? That's his value. There we go. Anyway, well, good. Well, thanks, Chris. Those are great points. No one said Pringles were ever terribly healthy, but at least M&M Mars is buying them out. So good luck to them.
Yeah.
So anyway, so Chris, we're coming to the end here, and we have just a couple of things I want to mention about the leadership matrix. We post lots of different blogs there, as folks know, and we put a piece out about crypto. So who's buying crypto, right? Crypto is holding up, and we always just look at Bitcoin, but there's 200 types of cryptos. But there's a University of Chicago study and an article about the metrics of who's been buying crypto lately. The stories have always been that, the younger folks do buy crypto and the older folks just talk about it. And that's pretty much played true in our firm. We've had a few folks over 40 buy crypto, but very few. People who are involved in the crypto markets are usually 40 and below. But if you look at some of the changes in that article, there are some new cohorts of people that are looking at cryptocurrencies and investing in it. Can you call it an investment? Sure. If it goes up or down, you'll have a gain or a loss like any other investment. But it is a very different investment than buying something with solid assets or a building or an income stream or a bond or something like that. So be careful if you do. This is not an offer to buy or sell securities. We just want to be real clear about that. But crypto is being bought by people you wouldn't have thought of. So have a look at that article. It might be very interesting. Also, we are going to be publishing, it's not out yet, out soon, but we're going to be publishing an article about that hyperinflation era of the 1979 to 1981 period, when the S&P 500 basically collapsed, and it didn't bottom until August of 1982. And that was caused by hyperinflation from the 79 to 81 period. So what would that look like if that happened again? So folks aren't unaware. I hope that doesn't happen, but we should know what could happen, just like what happened when they raised bonds, when they raised interest rates so sharply, and we had the worst bond market in American history in 2022. Those same things happened in 1980 to 1981. So let's see what hyperinflation looks like. And if it does happen, then we're prepared to deal with it. All right. And Chris, I think that's all we have. All right. I think we're done for the day. Thanks everybody for being with us. We'll be back with another episode. A lot of information here, folks, and we hope that you find this of value. Please tell your friends about our show. Give us a 5 for 5 ranking and send a copy of this show to your friends, and we'd appreciate that. We're trying to build up this podcast series, and it's going actually very, very well because of all you listeners. So thanks for your help. FourStar Wealth Advisors, today's Market Explained, over and out for today. Bye-bye, everybody.